Mr. Trainer, welcome. Good to have you with us. When you say a head fake, I assume you mean that this is a sucker's rally. Don't get pulled in because there's more volatility and possibly more steep air pockets ahead.
Yeah, that's right, Tyler. I mean, look, we've seen 20 years of ultra loose monetary policy pushing prices across multiple assets, even new asset classes like NFTs and crypto higher and higher. That liquidity is drying up. We've seen that already manifest in the SPAC market drying up and a lot of these hyper growth, unprofitable stocks coming way down. It's a regime change, and it's a world where fundamentals matter, valuations are going to matter. And that means that this rebound we saw in some of these meme stocks, super high valued, other unprofitable tech stocks that we've seen recently, it's a head fake. Investors should use this as an opportunity to get out with a little bit of profit in their pocket.
Yeah, so when you say hyper growth, but no profit stocks, you mean growth in revenues, but they're not making money. The same kinds of stocks that ran into trouble in the year 2000, 1999, 2001.
You know, that's right. Look, I mean, gravity is real. And in the stock market, gravity is about profits. And a stock ultimately has zero value if the business never makes any money. And as much as the top line can be alluring, and people like to believe that this company is the next Amazon and they're going to all of a sudden become profitable if they just grow enough, that doesn't happen very often. Amazon is an anomaly. It is not the rule. And too many people like to believe that some of these unprofitable tech stocks are going to become the next Amazon. And hope is not a good strategy in that situation.
David, what would your sort of overall advice be to investors? Is it specifically the Fed tightening that you think they have to focus on here?
I think the Fed tightening marks a regime change in how you invest. For the last 10 years or so, there's been no risk, right? I mean, look, you get great upside with almost no risk. Buy the dip has worked and worked and worked because there was a Fed put. And like the last guest, Bob Pisani, was talking, right? The Fed put has now changed. It's gone. It's more like a Fed ceiling or Fed call. And so that just means that you have to invest in the old-fashioned way, which is focus on fundamentals. Make sure that you're buying stocks in businesses that actually make money and are priced appropriately or cheaply. And that's all it means. And there's no free money or easy money in piling into momentum-based names like there was in the past. So it's not that you shouldn't invest. You just invest in a different way. The old way isn't going to work. The new way is the old way now. Right? Meet the new boss, same as the old boss.
Let's look at a couple of stocks that you say are potentially profitable ideas, beginning with O'Reilly Automotive and one that is in a very different kind of business, Royal Bank of Canada. What do they have in common that makes them appealing to you now?
Cash flow and cheap valuations. Both are generating a ton of cash flow. That cash flow is growing, and they're trading at stock prices that imply that their cash flows will permanently decline. So it's in a completely different paradigm of risk reward to like a Robinhood, which isn't making any money and whose stock price implies its profits are going to be bigger than Schwab, right? That's really bad risk reward. We'd say avoid that no matter what, but especially in this environment. And then if you have an opportunity, on the other hand, to invest in a company like O'Reilly Auto Parts, whose cash flows are tremendous and whose stock price implies profits are going to permanently decline by 10%, I mean, it's obvious, right? Like a completely different paradigm of risk reward, and really one where investors can find enduring value, not just in this kind of market, but I think in any kind of market.